Welcome to the Deep Dive, operating in our Talk Pickers format. Today, we are cutting straight to the core of a pretty massive pharmaceutical earnings call.
Yeah, the Q3 2025 results. And these delivered a genuinely significant market reaction. I mean, investor sentiment turned sharply bullish, almost instantly.
Right. So the mission today is really to dissect how management pulled this off this quarter. They've been, fighting that skepticism about patent cliffs, legacy erosion.
For a while now.
Exactly. And the fact that the stock jumped so much in one day tells you they finally maybe quieted those concerns.
Well, for now at least.
Yeah.
We need to understand the strategic messaging and, of course, the actual numbers that drove that newfound conviction.
Okay, let's unpack this immediately. Headline numbers first. What got the street so excited? It sounds like a clean beat, top and bottom line, good execution.
Yeah, financially, it was pretty strong, actually. Non-GAAP earnings per share, that came in at $1.63.
Okay, 163.
Which is a meaningful beat against consensus, right?
Yeah.
That was sitting around, $1.51 to $1.52. Solid.
And the top line, revenue.
Revenue hit $12.22 billion. Again, easily surpassing the consensus estimate. That was about $11.8 billion, give or take.
A beat's always good, but, what really fuels momentum is confidence. And management signaled that. They raised guidance.
That's the crucial part, isn't it? They raised the full year 2025 revenue outlook. The new range is $47.5 billion to $48.0 billion. That's up from their prior range.
Okay.
But what's really interesting, I think, is they maintained the midpoint of the full year non-GAAP EPS guidance. That's $6.40 to $6.60.
Maintained it, even after. Wasn't there a pretty big charge this quarter?
Exactly. They absorbed a notable net charge, but $0.80 per share.
80 cents, wow. Tell us more about that charge. I mean, that sounds like a huge number to just absorb without cutting the full year target.
It is. So that charge was related to acquired in-process research and development or acquired IPRD and some licensing activities.
Right, IPRD. So buying pipeline assets that aren't approved yet.
Precisely. And GAAP rules often mean you expense those costs right away. It creates a temporary headwind for current earnings.
So the fact they absorbed that 80 cents and still kept the EPS midpoint, that speaks volumes about the core business strength.
It really does. It shows real operational strength underneath.
So, okay, the core narrative holds. The accelerating growth portfolio is finally doing the heavy lifting, offsetting that, expected decline in the legacy portfolio.
It's the key strategic pivot in action. You can see it plain as day in the sales mix. Growth portfolio sales. They surged 18% year over year, hit $6.9 billion.
18%? Okay.
And that successfully counterbalanced the legacy portfolio. Those sales fell 12%, down to $5.4 billion.
And that legacy drop is mostly the usual suspects, generic pressure.
Yep. Primarily generic pressure on the big LOE assets, Revlimid, Pomalyst, Bristol, Abraxane. It was expected, but, 12% is still 12%.
Now, that portfolio shift is exactly what analysts wanted. But there's always a trade-off, isn't there? Especially short-term. If you're selling newer, maybe more complex products, requiring maybe different supply chains or needing discounts to get market access,
right,
that can really hammer your gross margin, right?
You've hit on the key scrutiny point going forward. Absolutely. That shift did cause gross margin compression.
What were the numbers there?
Non-GAAP gross margin dropped to 72.9%. Compare that to 75.1% in the same period last year.
Oof, okay, that's noticeable.
It is. Management's argument is, look, this is temporary. It's a consequence of the necessary transition. But investors, they'll be watching this metric like hawks. They need reassurance that long-term margin profile isn't, permanently degrading.
Fair enough.
Yeah.
Let's pivot to the good news, though. Yeah. Those product superstars driving that $6.9 billion in growth. Which brands are really hitting their stride, crossing that sort of magic $1 billion annual run rate?
Well, the diversification is looking pretty good now. Opdivo is still the main pillar, right? $2.53 billion, up 7%, steady. But the acceleration is happening elsewhere. Reblozyl delivered $615 million. That's up a huge 37%.
37%.
Yeah. And it's now firmly in blockbuster territory. It's annualizing well over $2 billion now.
Wow. And what's driving that Reblozyl growth?
It seems to be improved duration of therapy, plus just strong demand across multiple anemia settings. It's finding its place.
Okay. And what about the newer, maybe more specialized therapies, cell therapies, things like that? Usually high cost, high complexity.
Exactly. But they are scaling. Look at Breyanzi. Sales hit $359 million this quarter. That's a 60% growth rate.
60%.
And crucially, it has now crossed that billion-dollar annual sales run rate.
Another one hitting that mark.
And Camzyos, too.
Okay.
Exceptional increase there. 89% growth, hitting $296 million, also tipping into that billion-dollar annual territory.
So 4 distinct growth products now comfortably annualizing over $1 billion. That's a powerful story.
It is. And that's the metric management kept pointing to, showing they have control over the forward trajectory, despite the legacy erosion.
Okay, so strong top line from the growth drivers. But beyond that, we saw visible cost discipline too, right? That provides essential flexibility.
Yes. They showed remarkable control on the expense side. SG&A expenses were down 10% year over year, came in at $1.8 billion.
And that's linked to those productivity initiatives they announced?
Directly linked, yes. Management confirmed they're well on track to hit that $2 billion in net savings target by 2027.
And that's not just about, cutting costs for the sake of it.
No. This isn't just trimming fat. This frees up significant cash to reinvest strategically, and that leads right into their business development activity.
Right. Which brings us to that recent BD focus, the Orbital Therapeutics acquisition. This isn't about padding this year's numbers, is it? This feels like a long horizon move.
Oh, entirely. It's completely about long horizon optionality. They announced the definitive agreement to acquire Orbital, specifically for its in-vivo CAR-T/RNA platform.
In-vivo CAR-T, so different from current CAR-Ts like Breyanzi.
Totally different. Traditional CAR-T, like Breyanzi, is ex vivo, meaning you take the patient's cells out, ship them to a specialized lab, genetically modify them there, grow them up, and then infuse them back into the patient.
Which sounds incredibly complex and expensive.
It is. Complex, costly, logistically challenging, subject to manufacturing slots and supply chain risk.
And Orbital's in-vivo platform aims to change that.
That's the bet. This platform aims to engineer the T cells inside the patient's body using some kind of RNA delivery system. Think of it like delivering the CAR-T factory directly to the cells.
Okay, so potentially simpler, cheaper.
Potentially, yes. It could remove that whole external manufacturing process, cutting complexity and cost. And maybe just as importantly, it might broaden cell therapy's reach into new areas.
Like autoimmune diseases.
Exactly. Huge markets there, currently underserved by cell therapies. So this Orbital deal is a big bet on the next generation of engineered cell therapies. It's about the future.
Okay, fascinating stuff. Let's shift gears now to the investor context. That stock move wasn't just about Q3 execution, it's always about future catalysts too. What should we be watching near term on the regulatory front?
Well, the nearest one is actually Breyanzi again, one of those new billion-dollar runners. They secured priority review from the FDA for an SBLA.
An SBLA, supplemental biologics license application, so expanding its use.
Correct. Seeking approval for a new indication or usage for an already approved drug. The PDUFA date, that's the FDA's target date for a decision, is December 5th, 2025.
December 5th, so coming up pretty soon. That could broaden Breyanzi's market.
Could significantly broaden its usage profile, yes.
Right. And then there's the massive sort of binary elephant in the room, COPE-NV. Investor interest, maybe nervousness, is still super high around that Alzheimer's disease psychosis program.
Yeah, COPE-NV. Look, the commercial launch in its first indication, schizophrenia, is apparently tracking okay, but management was pretty candid. It's tough disrupting entrenched prescribing habits there.
Right. Changing doctor behavior is hard.
It is. But the real pressure, the big focus, is on the phase 3 ADEPT-2 study readout. That's for Alzheimer's disease psychosis. Still expected by the end of this year, 2025.
End of 2025. Okay. And that's arguably the biggest single binary event for them this year.
I'd say so. Definitely the one carrying the most weight in terms of potential upside or downside right now.
And what's the regulatory bar there? What do they need for approval in Alzheimer's psychosis?
They need 2 positive pivotal studies out of the 3 main ones, ADEPT-2, ADEPT-3, or ADEPT-4.
2 out of 3 need to hit.
Correct. Management expressed, continued confidence. They cited external data, internal data, but they also acknowledged the execution focus needed. Alzheimer's trials are notoriously difficult.
And the market seems to have priced in a fair bit of success there already.
That's the perception, which makes this ADEPT-2 read out the most immediate high-stakes test of their whole neuroscience thesis.
Okay. Looking beyond this year then, what about the midterm? You mentioned a big pipeline acceleration coming in 2026.
Yeah, 2026 is going to be incredibly packed. They're guiding for pivotal readouts for, get this, 7 new molecular entities, plus 7 life cycle management opportunities.
7 plus 7. Wow. Any standouts there?
The biggest potential impact, arguably, is milvexian. That's their factor Shea anticoagulant program.
That factor Shea. So next-gen blood thinner.
Exactly. The holy grail here is reducing clotting risk without significantly increasing bleeding risk. Bleeding is the Achilles heel of current anticoagulants like the factor J inhibitors.
If they can crack that, that's a massive shift in cardiovascular medicine. What are the key milestones for milvexian?
There are 3 huge phase 3 trials, one in acute coronary syndrome, ACS, one in secondary stroke prevention, SSP, and one in atrial fibrillation, AFib. All 3 are expected to read out sometime in 2026.
All in 2026.
Yep. If these studies hit, milvexian could be a multi-billion-dollar drug. It could fundamentally change treatment standards. Huge potential.
We also heard updates on their protein degrader platform, right? That's another novel area for them.
That's right. They highlighted phase 3 data for iberdomide, specifically in relapsed refractory multiple myeloma.
And the data looked good.
Apparently showed compelling MRD negativity rates. MRD is minimal residual disease, basically, undetectable cancer cells. That's a really high bar.
And that opens the door for
discussions with health authorities about potential accelerated approval pathways. So they're clearly pushing hard, leveraging their leadership in that novel therapeutic area.
Okay. One last piece before we get to the trade idea, the policy environment. The Inflation Reduction Act, the IRA, that still hangs over all pharma stocks.
It does. For this company, the negotiation process for Pomalyst under the IRA is concluding. But management sort of downplayed the impact.
Why is that?
Well, Pomalyst is expected to lose its exclusivity, its LOE, in the U.S. pretty soon anyway, by January 2027. So the IRA price negotiation impact is kind of mitigated by that impending generic entry.
I see. And they also talked about patient access programs.
Yeah, they highlighted their direct-to-patient, or DTB, programs, specifically for Eliquis and also for Acopanvi. These seem to involve offering pretty substantial discounts off the list price directly to patients, kind of getting ahead of access concerns.
Okay, so summarizing the quarter, defined by strong operational execution, getting a really robust reward from the market for it.
Absolutely. Delivered on the numbers, delivered on the growth story.
All right, now let's move into our segment where we try to synthesize the risk and pitch an outrageous but maybe plausible trade idea based on everything we've just discussed.
Okay, but first, the crucial disclaimer. This is not investment advice. Seriously. We are simply synthesizing the market's current risk assessment based on the call details and the pipeline setup we just went through. Nothing more.
Understood. So the thesis goes something like this. The stock had a big jump, rewarded the commercial success, yes, but also, critically, priced in a premium for pipeline success.
Right. A lot of future good news baked in, perhaps.
So, given the historically high failure rate of Alzheimer's trials, especially for novel mechanisms like Popanvi's, where's the most asymmetric risk right now?
Well, the outrageous but plausible idea centers on that risk. It's a short-term, potentially asymmetric hedge against a negative ADEPT-2 readout for Copanvi.
A hedge against failure.
Exactly. We think the market might have priced in maybe too much certainty on this single binary event. That potentially creates an opportunity for let's call it cheap insurance.
Okay. And how would you structure that insurance?
The idea would be to consider purchasing far out of the money put options.
Puts. Okay.
Expiring, say, in early 2026. So maybe a month or two after that anticipated ADEPT-2 data release window closes, end of 2025.
Got it. So you're buying inexpensive leverage, basically, for a potential catastrophic drop. If ADEPT-2 fails, the market likely re-rates the stock harshly, right? It pulls out that neuroscience premium.
Instantly. And those far out of the money puts could potentially capture a significant portion of that downside move.
But if the data is positive, or even just okay,
well, then you likely lose the premium you paid for the puts, which should be relatively small if they're far out of the money. But you still hold your core position, benefiting from the positive data and the underlying commercial strength.
So it isolates the biggest near-term clinical risk, allows you to hedge just that binary event without ditching your whole thesis on the commercial side.
That's the concept, using the options market to manage a specific high-impact uncertainty. Again, purely hypothetical, not advice.
Okay. So wrapping this all up then, this quarter felt like proof of concept. Management delivered on execution, showed those billion-dollar growth brands are scaling fast enough, offsetting the legacy drag. And the strategic BD, like Orbital, is clearly focused on those next-gen, high-potential platforms, long-term vision.
Check. They executed pretty much flawlessly on the commercial transition story they've been promising for a while.
Right. So the key question, maybe for you, the listener, to really consider now is this. The market clearly rewarded that execution with a big thumbs up. How much upside is truly left in the near term, given that a lot of that success might already be reflected in the price?
Yeah, the focus really shifts now, doesn't it? It's less about Q3 results, which are now in the rearview mirror.
And much more about the outcomes of that highly accelerated 2026 pipeline, milvexian, the protein degraders, those remaining adept studies for COPD.
That's where the next significant leg of value, up or down, will likely be determined. It's all about pipeline execution from here.